Welcome to another video. Today we'll be looking at 5 undervalued stocks for April 2024. Now these are not by recommendations, it's just stocks that I believe that you should take a deeper dive into because they seem very attractive at the prices they currently are in. So let's start with United Healthcare, ticker symbol UNH. This is located in the healthcare industry, and over the past year, it's actually down around 12%. This is due to some regulation changes regarding Medicare in the US, and it has negatively affected the company. And as you can see, the valuations throughout 2023 were actually pretty stable, only the price to cash flow ratio increasing, and now of course it has dipped, but in Q1 2024 we still don't have that data, so we will have to see what that comes in when they report earnings. Now, what's good about this company is they pay a very healthy dividend, which is extremely stable. It's currently sitting at a 1.65% dividend yield. And the good thing about this dividend is that it is growing at a super fast pace. It has a 3-year dividend CAGR of 9.2%, which is something incredible for a stable dividend paying company. Now, this company trades with extremely low margins, and it's because it's in the healthcare industry, so it cannot have extremely high margins. However, their revenue has been increasing consistently throughout the quarters, and their operating profit and net income have been pretty stable throughout the 4 quarters of 2023 as well. Now, when looking at their free cash flow evolution, it is a bit worrying, and I don't like to see this trend where every single quarter it has actually gone down. Now, as we said, you can see that their margins are pretty low, with their operating margin sitting at around 8% and their net margin sitting close to 6%. However, they do have a very good balance sheet, with their total assets being way above their total liabilities in every single one of the last 4 quarters. And as you can see in the last one, they're actually making some effort to reducing that liability and bringing that assets to liabilities ratio to a better, safer place. Now, the second stock we have here today is Lululemon, which is a stock that was recently affected by their earnings. This is a stock in the athletic apparel industry, and as we can see over the past year, this company is actually down only 2%. However, all the run-up that it had in price since November 2023 has now been lost. Now, this stock, we can see that their valuation ratios are actually decreasing. They started the year 2023 at a 51 PE ratio and a 35 price to cash flow ratio. And right now, well, last quarter in quarter 4 2023, they actually came in at 40 price to earnings ratio and a 25 price to cash flow ratio. Now, this company does not pay any dividends, so there was no CAGR and no information on this stock. However, when we look at the revenue and income evolution, this is a magnificent company. Just look at the hyper growth that it achieved in revenue, gross profit, and net income in quarter 4 2023. Of course, this is great to explain the chart and the run-up that we saw in November 2023, and this quarter, since everything came in a bit lower than expected, this is why the price has actually dipped. But now, this company looks wonderful in terms of free cash flow evolution. As you can see, in the first quarter of 2023, they actually came in at negative cash flow, and now they have been increasing it to the point where in quarter 4 2023, they actually generated over $1.2 billion in free cash flow. Something beautiful, and if they actually manage to keep that stable, this is for sure a company I'll be taking a deeper dive into. Now, their margins are very solid, with their gross margin sitting at just under 60%, their operating and their net margin also being very stable. And in terms of balance sheet, this company also looks wonderful, with their total assets being way above their total liabilities, over double than their total liabilities for a very long time. And as you can see in quarter 4 2023, even though they increased both assets and liabilities, they increased assets by a lot more to ensure that that asset to liability ratio would remain under control. So this is a wonderful stock. Now, the next stock is SBUX, ticker symbol SBUX, which has had a very rough year, and it is down around 70%, reaching a 1-year low of $86. Now, the valuation ratios for last year actually prove that this stock has been getting cheaper every single quarter, as it started the year with a PE ratio of 33, and last quarter, in quarter 1 2024, it actually had a PE ratio of 26 times, showing that this stock is undervalued when comparing its price to earnings ratio historically. Now, what's wonderful about this company is that it pays a very solid dividend, which has actually been growing at a 5.6% 3-year dividend CAGR, which is wonderful, and it's currently yielding a 2.53%, which I'm not sure that SBUX has ever yielded such a high dividend. So meaning that this could also be an attractive entry point for the stock, as long as their fundamentals are actually looking solid. Now we can see that the revenue has been increasing every single quarter, however their margins actually contracted last quarter, as their gross margin, for example, went from closer to 25% to closer to 22%, and their net margin went from a 13% all the way down to a sort of an 11%. This might be worrying, and although Starbucks is a fantastic company, before buying the stock I would recommend to actually investigate that and see whether that was a one-time thing or whether these margins will be affected in the long run. Now, regarding the cash flow of this company, it is actually amazing. In Q1 2024, they returned $1.75 billion in cash flow, and every single quarter they are returning massive amounts of cash flow to the stockholder in forms of dividends and also share buybacks. One thing I do not like about this company, and it's a red flag, is their balance sheet, as their liabilities are consistently above their assets for a very long time. And as we can see in the previous quarter, they actually increased their liabilities and decreased their assets, worsening their position. Fourth stock is Nike Inc., which is down around 26% in the past year. And as we can see through their valuation ratios, they have actually improved a bit from 34 all the way down to around a 25 P ratio. And now this is also a company that pays dividends. They have a very solid dividend yield of 1.6%, which is one of the times I've seen Nike with a higher dividend yield. It usually trades at around a 1%, 1.2%. And what's good about Nike's dividend, it's that they have been growing it at a 7.5% 3-year dividend CAGR, which is incredible for a solid dividend. It is worth to note that in Q3 2023, they actually had lower revenue, gross profit, and net income than the previous quarters. So this might be a red flag for the future. You should check whether this was a one-time thing or whether this is expected to be happening in the future as well. Now, in terms of cash flow, they had one quarter with negative cash flow because I believe they conducted either a huge investment or an acquisition. However, the other quarters, they were normal Nike, having incredibly large cash flows to return to the shareholders. And they do have a very solid balance sheet, as their total assets have been above their total liabilities for the past quarters, and that is very positive for such a high quality company such as Nike. Now, last but not least, we have Lantheus Holdings, ticker symbol LNTH, and I'm proud to say that I actually purchased this stock a couple of weeks ago. I stated on my Patreon that I had initiated a position in Lantheus Holdings because I believe that it is a company which is trading at an extremely attractive valuation, which has extremely high growth potential due to the introduction of one of the most novel products, which has been approved by the FDA and is right now targeting the broad market and has a lot of demand for it. As you can see, they are actually having very high growth, especially in the last quarter, because they released a new type of product or they got a new approval. Now their margins are extremely high, and it's important to note that this company has only had 3 consistent quarters of being profitable. In Q1 2023, they actually lost money. And now, in terms of cash flow evolution, we can see that their last 2 quarters were actually very positive in terms of free cash flow. However, in Q2 2023, they actually yielded negative cash flows. When looking at their balance sheet, we can see that their total assets are way above their total liabilities, with a very safe asset to liability ratio. So thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic or Trading 212.